This is your brain on risk. This is Mind Over Money, the podcast where Kevin Cook exposes the psychology of investing.
Welcome back to Mind Over Money. I'm Kevin Cook, your field guide and storyteller for the fascinating arena of behavioral economics. Fintech innovations are changing investing tools and behavior in powerful ways that you must begin to explore if you are an investor at any age. In fact, even if you think you are too young or too old to invest, you should listen to this, especially if you know anyone employed in the financial industry, because that job market is about to go through some drastic changes at the hands of AI, or artificial intelligence. And today I have an expert on both investing and AI who is going to help us understand the changes that are coming. Gaurav Chakravorty is the co-founder and CIO of qplum, an asset management firm that offers deep learning and AI-based trading strategies. You may recall on my November 1st episode titled Deep Learning Goes to Wall Street, I talked about qplum as a new disruptor on the investing block. We'll meet Gaurav in a moment after I give you some background. One of qplum's mottos is, investing can now be a science and not a game. And to achieve this goal, they are using dynamic AI strategies and protecting against downturns. In describing their core investment philosophy on the company website, the qplum team says, "We believe in the mathematics of data-driven decision-making, the science of behavioral economics, and the art of effective communication." qplum emphasizes that they are offering investing strategies, not products. And those products are coming from a data scientist and computer engineer, Gaurav Chakravorty, who spent the start of his career building machine learning models before he took finance classes at Wharton that inspired him to bring the two worlds together. Contrary to Wall Street hedge funds that hire quantitative PhDs to build complex investing and trading algorithms, qplum taught their AI to learn on years of market and economic data what works best in the long term if given the chance to rebalance a portfolio. Gaurav, welcome to Mind Over Money.
Thanks for having me.
Oh, you bet. So I told you that I have a love-hate relationship with the algos on Wall Street. I was a high-frequency currency trader who was eventually replaced by a computer that could do arbitrage better, bigger, and faster than I could. And I wasn't depressed about that a few years ago because it forced me into the world of equities, which I feel are a richer universe of investing themes and challenges. But now, as much as I love the potential of artificial intelligence, and I'm an investor in NVIDIA, I'm reading an article by you from October titled, "Artificial Intelligence is Disrupting Asset Management Jobs Now. Don't Get Left Behind." Gaurav, are you telling me my career as a stock picker is in jeopardy and I should be looking to expand my knowledge and skill set?
No, it's just that the tools that you will have at your disposal will change. A lot of the work that you are doing now, you'll not need to do. However, you'll probably want to understand AI at a level that you can use the tool effectively. So a lot of aspects of stock picking are analysis, and it's not a pure science, it's a social science. So a lot of them are an evolving form of analysis. So that aspect, I think, can be done more effectively using AI. However, exactly what to do, how to use the results, all that is still a CIO's decision, a portfolio manager's decision. And, if you understand the AI better, I think you can just do this much better.
All right. So let me try and describe the basic offering of qplum, and whatever I get wrong, please feel free to correct me. So what you're doing is you'll manage money for people, and you're just using ETFs. And on your website, I see over 3 dozen ETFs in a lot of different sectors, regions of the world, that kind of thing. And then you have strategies based on people's time horizon and their risk tolerance. But the way you built your model is in the way I was trying to differentiate you from the quant invasion on Wall Street of the past 20 years has been, hey, let's hire the PhD in math or engineering or physics and have them come in and tinker with some data and then build us a particular model to trade a particular way or a particular asset. What you've done is you looked at many decades of data, and not just price data, but macroeconomic data, and you tried to come up with a way to either match the market or beat the market for long-term investors. Is that correct?
Yeah, as an investor, I mean, firstly, everything you said is spot on, and I just wanted to explain the core service that we are performing is that an investor, essentially, almost no investor cares about beating the market, or that's a derived statistic. What they basically have to do is they have some money, they have some liabilities, and they have some general uncertainties, and within this hazy picture, they have, and within the time they can spare, they have to do the best they can with their money. Now, we use AI in two ways. One is to understand this hazy picture, and I'll come to that. And the other is once we have a good idea of what the investor is working on, is trying to achieve, then building a solution for that. Now, the solution is about investing. It's not trading. We believe in investing and not trading. What I mean by that is we believe in using all the money, like making a holistic portfolio that includes risk management, that includes liquidity concerns, and is most tax efficient. So it includes all the real aspects of life. It's not just a standalone portfolio that'll work for, an IRA account or something. And using all of this in machine-driven, a data-driven way to provide the goal that the investor had. If it's maximum returns over a 5-year horizon, 10-year horizon, whatever that is, optimized for that.
Okay. Well, what I like about the whole approach is that, even with our access to institutional platforms, whether we have a 401k or we have an IRA, and we get to choose our mutual funds, or we get to choose our stocks or whatever, people still tend to do the wrong things when it comes to long-term investing. We still have all those behavioral biases and blind spots that make our money go away from us. So I like the idea of anything that's systematic. And so, so I see these four blended or these portfolios that you offer, the flagship, the Lotus, the Fairway, and the Sunflower, and they all have, a target risk, and they all have, an idea of, are you an aggressive investor? Is it a retirement portfolio? Is it income with capital preservation? But you're also saying that you will customize to the person.
Yeah. So our job is to provide solutions, as I said. So for instance, while there are these broad model portfolios on the website, once a person decides to invest with us, the conversation we would have is, first we would look and ask them if they have accounts already at TD Ameritrade, Fidelity, etc. Because people hate moving accounts. Big problem with this new age robo-advisor revolution is most of the robo-advisors have become robo-brokers, and they cause you to, sell all your stuff and move your money, which is a bad tax game anyways. So we say, you don't have to do that. We'll manage your accounts where they are. Next step we ask is, instead of asking you a risk number, are you in the 0 to 10, where are you, instead of asking that, which nobody knows the answer to,
right.
we ask them, how would you feel if you're up 6% and let's say the market is up 12%? Or how do you feel if you're up 6% and the market is down 12%?
Okay.
So you ask them 2 or 3 questions, and using our simple machine learning model, we come up with what we call the utility function. And this is the same idea that Harry Markowitz or Daniel Kahneman talked about, a utility function. And based on that mostly gets our job done. From that, we will be able to construct a portfolio of strategies, again, not for products, investment strategies, which maximizes the utility function of this investor. Only additional part that we do in customization is most investors are usually overweight something, as in maybe I have I'm overweight real estate. Maybe a lot of my wealth is in my house, or maybe I'm just holding a lot of cash. So we ask that information, and that's it.
Okay.
So based on that.
And you also have bond funds, and you have 2 ETFs that could give real estate exposure too, I see. So
Yes.
So tell me, walk me through how it works. If somebody, you've customized a strategy for someone, and let's say I'm a long-term investor. I really don't want to see the money for 30 years. I just want it to grow with the economy, maybe with the global economy. How often are you adjusting or rebalancing my strategy?
So rebalancing is something that should be done as often as possible. In fact, our old business, high frequency, is about rebalancing every 2 seconds if we can.
Right.
So we try to do that systematic rebalancing. We do it daily, and we're trying to move to even higher frequencies. Now, in terms of strategies, rebalancing now, right? What I was talking about rebalancing is inside a strategy. But in terms of rebalancing between strategies, as in, is this a good environment for crisis-driven trade, or is this a good environment for a pro-growth trade? That strategy allocation, that is not changed that often. Usually, that sort of a strategy change would happen if the macroeconomic data changes. For instance, the payroll growth number came out as 228,000. If it was, minus 50,000, that would probably cause us to change that, a portfolio of strategies.
Yeah, so tell me more about that. I know when we talked before, you said you looked at 70 years of macroeconomic data. What inspired you to go that deep and then have an AI model that could sift through those patterns?
It's a very good question. I think, like you were saying, that right now a lot of investors have a long-term outlook and they're looking for growth. And this is a prototypical behavioral bias. When the market crashes, a lot of people look for capital preservation. And these cycles will keep happening. We can't change that. The best we can do is study how that happened. And the Federal Reserve has done an amazing job since 1950s of collecting U.S. households, how much we have invested in each asset class, how we have changed allocations, where we have taken money out of. And looking at that, so one observation I'll tell you is that apart from the financial crisis, any time where U.S. net wealth has dropped 5%, just 5%, it's been a huge crisis, like think of the tech bubble of 1978, so all these crises, the worst drawdown was just 5%. In terms of a behavioral model, we know that investors just don't, they panic if they lose money. And this sort of information, this sort of quantitative data tells us that crisis-driven trades will start working if the net wealth of the country suddenly drops by, 4 or 5%. Now, given today's allocation, which is also published by Federal Reserve, they also say currently about 52% of our net wealth is allocated to equities. That tells me that if stocks drop around 10%, then we should shift to, the strategy allocation should shift to a more crisis outlook.
Okay. And are these periods also in conjunction with a recession as measured by GDP in the economy?
Yeah, so yes and no. Some of these 5% drops were in conjunction with recessions, but some of them are not. For instance, the 2000 crisis, recession happened much, much later than the market dropped.
And another thing I like about your approach is that, I don't know if I fully understand sort of the daily rebalancing, but one thing I like is that you're trying to be as tax efficient as possible, and so you'll be able to do loss harvesting, be able to sell something, capture that loss, but then shift into a similar ETF that gets the person back in the market without, avoiding the 30-day wash rule.
Yeah. So once we notice that some positions have significant losses, then what we could do is we would sell those positions proactively, even if the portfolio model is still allocating to them. And we would mark them that we should not buy them again in the next 30 days. And now for the other assets that we can hold in that portfolio, we would try to how to position in them so that we are closest to the model portfolio using correlation and different simulations of what is similar. So almost we can get the same exposure just proactively locking in losses. Now, for high net worth individuals, what is more important, like tax loss harvesting works but for high net worth individuals, tax gain deferral is even more important, which means that making sure you don't sell assets which have significant gains.
Right. Now, so your model is obviously automated, right? Or you wouldn't be able to do it for thousands of customers at once.
Yeah.
So, but you're saying people can keep their money at the broker it's at.
Exactly.
So does that involve some kind of API where you're plugged into the broker?
Exactly.
Okay.
Exactly. So our work is to integrate with every major broker. We have maximum number of integrations in the API integrations among robo-advisors currently, and then onwards, every broker will have their own special considerations. For instance, the commissions might be different per broker, or just the set of ETFs that are commission-free at the broker might be different. It takes a lot of work, but we look in all of that, and we might be, expressing a real estate portfolio differently on TD Ameritrade than on Interactive Brokers. And just doing all of this in a diligent manner.
Okay, yeah. And I see that it's pretty obvious if somebody goes on the qplum site and looks at the ETFs, a lot of Vanguard ones, and that obviously Vanguard is known for having very low-cost, cost-efficient ETFs. And then so generally you're trying to find the optimal transaction cost to make this also appealing. It's not just we don't have to pay up. In other words, to have the artificial intelligence in quantitative investor, right?
Yeah. I think there's a lot of talk around AI right now, and one of the things that I've tried to explain to people is that AI, the use of AI, is to just do what we are already doing in a more efficient way. I do not recommend people to chase AI for the sake of higher returns, but use AI to do things more systematically in a more cost-efficient manner without human biases.
Right, that makes a ton of sense. So right now, just ETFs, do you have any plans or any visions that down the road you might also be picking stocks and assembling sort of your own portfolios?
Yeah. So we are working on a single stock portfolio as well, and using fundamental data. We believe a lot in using data that is not just price volume, whether it's macroeconomic, fundamental, or eventually unstructured data like sentiment data. For higher capacity portfolios, and we're working with large institutional clients as well. So for that sort of audience, they would want to be strategic, yet not very high turnover. So in that respect, fundamental data helps a lot. We are certainly working a lot on single stock data and with the focus on company fundamentals.
Can you talk about assets under management or performance right now?
Sure. We have about 37 million assets under management. We have about 400 clients, and our returns about 28% since last January, end of last January 2016. Our Sharpe ratios are about 2.2.
Okay. And you said 37 million under management. How much of that is institutional?
That's on a separate vehicle. I'm
Sure.
not counting institutional.
Okay, got you. That was just individual clients. Okay. Yeah, I think that there's so much to be done here. As you pointed out, that AI doesn't replace us; it enhances and augments what we're able to do in terms of not just sophisticated research, but then monitoring and deployment and execution. Right?
Exactly. In terms of asset management, I think a shift that's happening. Yet I feel not a lot of people who are working in asset management are aware of it, is that asset management is finally becoming technology business. So, there are friends of mine who are, those $1 million salaries, doing very well, but in a very intensive way in which they're, trading and taking a lot of stress. A lot of that will go away. However, there'll be a lot of investment in just technology roles like computer security, DevOps, data infrastructure, big data, how to manage millions of machines. Traditional portfolio manager having a very cool head and deciding under stress, that will be, that's not a position I see in the years to come.
Right. We can let the machines do some of the hard, monotonous work, and leave us to creating ideas. I always tell people, when you try and beat the market, you've really set yourself up a task, and that, and those people get headlines. But as you pointed out, if you're an investor who just wants to grow your wealth over time, don't worry about beating the market every year, because it's, if you just wanted to buy the spiders, the S&P 500 index fund in a mutual fund or just the SPY, great, but then you're going to watch it go up and down. Whereas you have a more adaptive strategy with qplum, like, we're going to try and do what the market does, but we're going to be able to enhance it with tax-efficient strategies, paying attention to macroeconomic data. And so hopefully, you and I talked about this before. I asked you, well, you've only been around in this bull market. So how does somebody know, that you'll be able to survive the next period of economic or market volatility? And what's your answer to that?
So firstly, I myself as a trader have been trading since 2005, and all with machine learning-based strategies. I saw the market before the last crisis, which was also very, very calm. VIX was again at 8 to 9. And then the crisis, the onset of the crisis, coming out of it, where people were continuously afraid that, things are again going to go south, but it kept going up. So I've seen a lot of market seasons. But when building strategies, we hold a simple axiom. We make strategies in a way that don't cheat. In the sense, we make a strategy, test it on the next day, and make another strategy for the next day. This is called walk-forward analysis.
Yeah, so let me just explain to some of my viewers who may not be familiar. So what a lot of traders and quantitative and fund manager people do is they want to look at past data. So then they run a back test and see, how would this strategy work on past data? But sometimes that can optimize to just what happened. So somebody can do something and say, I would have bought the low in 2009. But to really test it, you do something called walk-forward optimization. So can you explain that?
Yeah, so it's like the machine, if it's building a strategy, then let's say October 5th of 2008, what it's going to do on that day can only, it can only figure that out using data till October 4th of 2008. It's not allowed to look at data after that. Well, this seems like an obviously good idea, but just to do this, which will entail us to make a new strategy, new parameters, new optimization to be run every day of the backtest.
So you can show that your strategy would have, in a crisis, it's going to pick a point and say, we probably need to reduce equity exposure here. And then at some point, as conditions are troughing, fear might still be rampant. The VIX could still be at 50, 60, 70.
Exactly.
And volatility is high, but conditions are stabilizing such that your model, because it uses macroeconomics, would recognize opportunity to redeploy and get back in the market.
Exactly. So right now, you and I can see to the past history and say, on March 9th, 2009, the market troughed at, I think, 666, but and we can make a strategy that, going forward, if the market ever drops 57%, then buy.
Right.
But that would be cheating. We didn't know that before March 9, 2009, and that's what the strategy does. We run strategies in a way that on March 9, 2009, it would not know that tomorrow it's going to suddenly start going up. And hence, it's very hard to overfit to the past using walk-forward analysis.
That's great. And and AI is the power tool for that, for sure. Gaurav, this has been a great discussion. I'm really excited about what you guys are doing at qplum. And I think you're right that this is, this is a big part of the future for Wall Street and for investing, for people to have this kind of option. As an individual investor or as an institution, I can see that this is just going to keep growing. So really great to have you on and talk about the future of Wall Street.
Thanks. And many of the things you described much better than me. I think you're doing a great job in helping people understand what's coming and how it's relevant to them.
Yeah, I mean, we you know what? We're human. We're always going to have greed. We're always going to have fear. We're gonna have regret. We're going to have panic. And so if we can, have a model that sort of taps us on the shoulder and say, well, this is really what you should probably be doing. I think we all need that in our investing. All right. Yeah. Thanks so much, Gaurav.
Thanks. Take care.
That was Gaurav Chakravorty from qplum, and was his unique AI investing model and set of strategies that's going to be part of a revolution on Wall Street. All right, thanks for joining me once again on Mind Over Money, and we will talk to you soon.